सेकंड मिश्रा जी आपने किया?
Yes, sir.
Hello and good evening, everyone. Wishing you all a very happy Navratri festival on behalf of Team WIRC. First, I request the ICI motto to be played, please.
येष सुप्तेषु जाग्रति येष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Thank you so much. So, as we all have very recently packed up our financial years 23-24, we have to also unravel our tools and sharpen our skills for the respective further professional pursuits of ours. And this very undying zeal for learning brings us here again to educate ourselves about the recent EAC opinions on the INDAS. Before setting our foot on the journey ahead, I request respected Chairman Sir, Sri Ankit Rathi Sir, to kindly join us for his welcoming address.
Thank you, Apurji. Very good evening. It's indeed pleasure to be here in this virtual room with you all. Friends, as we all know, the expectation of our stakeholder and regulator is very, very high from all of us. So we as a council member and the chairman thought, why we not continues provide a valuable lessons about the INDAS, AS, auditing standard on that Tuesday. So we start a new initiative called Technical Tuesday, in which we called experts, faculty from across India about the particular subject. Today we have with us Gauravji. Gaurav bhai, thank you so much. Despite of your so much busy schedule, you accept our invitation and being agreed to share your valuable knowledge with our participants. Let me also thanks to Apur, coordinator. Thank you, Apur bhai, for giving time to the ICI, our fraternity. Friends, let me tell you the opinions of our expert advisory committee is very well addressed by the Gaurav in our this session. Wish you all a happy learning. With this, I request Gaurav bhai, please take the charge. I will not take your much time because we all are here to listen. Gaurav bhai, thank you so much.
Thank you, Ankit. First of all, I would like to thank the WIRC for this session, for keeping these sessions. It really helps people to learn more about the INDAS and the way to conduct audit, especially considering the requirement of the regulator, the increasing requirement of the regulator to improve the quality on day-to-day basis. So, thanks, Ankit, to take this initiative. Okay.
Thank you, Ankit sir, for setting an energizing tone for today's session. So I would like to request everyone present to pay a keen interest on the interesting profile of our speaker, CA Gaurav Hallan sir. Gaurav sir is a director in SRBC and Company LLP Mumbai. He has 17 plus years of experience in audit and assurance services and specialization in statutory audits. He has worked on audit engagements in multinationals in India as well as overseas. And his forte includes sectors like sugar, power, renewable as conventional, and auto ancillary, etc. He likes mentoring interns and newly qualified CA. As a person, he loves to read and gain knowledge about industries and companies and meeting new people. So, Gaurav, welcome, and the stage is all yours now. I request you to kindly take charge of the session.
So I'll just share my screen and we'll just start off. Okay. So friends, some basic things. I would like to keep this session interactive. When I say interactive, I'll be covering about 9 EACs which have been issued by the Expert Advisory Committee. So, after each EAC is completed, I would request if you have any questions, we can take it at the end of each EAC rather than waiting to the last, because all these are very technical EACs. I've handpicked them considering the fact about what we do in our day-to-day work. And I'm sure these EACs or these learnings are going to help you perform your routine work as well. So to start, just give me 1 second. I just cannot see the chart window, so I would not know if. Okay, I have it here now. Okay. So as I mentioned, I'll be covering about 9 EACs across various standards. That is INDAS 40, which is on investment properties, AS 16, which is on property, plant, equipment, 116 is on leases, 109 is financial instruments, and INDAS 32, which is on presentation of financial instruments. I've also selected 2 very interesting EACs, which is not on technically on INDAS, but it is very much relevant to the INDAS financial statements. Those are in terms of presentation. So moving to the first EAC, the first EAC is on the first opinion is on INDAS 40, and this has to do with the property developed on a joint lease land, and few of the floors of the building being occupied by the parent company, but the entire asset is in the book of the subsidiary. So the background of this particular case was that a common land was taken on a perpetual lease by the parent and the subsidiary company, and both the company, the lease was taken from the state government department. Both the companies constructed 2 buildings of 5 floors each, which had a common basement and the ground floor. The cost that was incurred was about almost 50%, but the subsidiary incurred a bit higher cost as compared to the parent, and the respective cost was capitalized in the books of each of the companies. There was no demarcation of the property because it was a common piece of land. However, de facto, the Tower 1 was entirely used by the parent company, so it was of the parent, and Tower 2, which was partly used by the subsidiary and partly used by the parent, but it was in the books of the subsidiary because they had spent all the amount for the Tower 2. As I mentioned, Tower 1 was capitalized in the books of the parent, and Tower 2 was in the books of the subsidiary. So out of the 5 floors, of the Tower 2, 3 were occupied by the subsidiary and 2 was occupied by the parent. As time elapsed, the joint executive committee of both the companies, it is a PSU, so they have a joint executive committee to take the decisions for them. So in the joint executive committee, in the joint executive committee, both the companies decided that the 2 floors that were occupied by the parent in Tower 2 will be sold off to the parent company. But the problem here was, since it was a leased land and not an owned land, and there was no partition of the land, so there could not be a clean demarcation as to whether they can sell these floors or not. However, in the interim, the auditors raised objections that the subsidiary is giving the asset to the parent company for use, but they're not charging any consideration for that. So that does not technically becomes an arm's length transaction. So it was decided that the subsidiary is going to charge consideration to the parent for use of the 2 floors that they were using. The consideration was to be charged from retrospective effect and for a future period of 10 years. And in the books of the subsidiary, adequate disclosures regarding the fact pattern was given. Now the question arose as to the accounting treatment or the disclosure of the two floors that was held by the in the book of the subsidiary, but was being used by the parent company. Whether it has to be treated as a as a investment property in the books of the financial statements of the subsidiary, or whether it has to be classified as a property, plant, and equipment under INDAS 16. As we are all aware, management and auditors have different views on certain topics. So this was the case here as well. The auditor's view was, the government auditor's view was, since the company is earning lease rental from the two floors and the sale of the floor was approved, so capital appreciation cannot be ruled out. Further, they mentioned that since historically the floors were used by the parent company and not by the subsidiary does not have any intention to use those two floors in the production process or for supply of goods and services or for administrative purposes of the subsidiary. Accordingly, the auditor suggested to account the two floors as investment property and not PPE. Here, I would like to highlight that an asset is classified as an investment property when the intention of the entity is to earn rental out of it, or for capital appreciation by selling the asset in future. So if these two criteria are met, it is treated as an investment property. So that is where the auditors were coming from, that since you're earning rental and the sale is approved, so you are going to get capital appreciation. And also because you're not using it for your own purposes, it should be treated as a PPE. To this, the management's contention was that para 5 of INDAS 40 specifies that the primary criteria is the intention or the objective of the owner for holding the property. Just because I'm giving it on lease rental, that doesn't mean that my intention was always to give it as a rental. Further, the subsidiary management mentioned that their intention was always to use the building for administrative purposes, the whole 5 floors. However, since the parent was short of space, they wanted additional space, and that is where they are using the additional 2 floors of the Tower 2 as well. Few other contentions of the management was they never intended to charge rentals to the parent company. However, since it's a related party transaction, in order to maintain arm's length of the transaction, they have to charge rent, though it was not the primary purpose of the subsidiary. The subsidiary company also contended that the capital appreciation, it's possible at the time of sale, but that cannot be the only criteria for determination of a property held to be an investment property. Furthermore, management noted that they cannot sell the property because it is not a freehold land, and also because they are using a significant portion of the building. So out of the 5 floors, 3 floors were used by the subsidiary company. INDAS further, this is the contention of the management again, that INDAS 40 para 14 says that in case it is tricky, the management of the company should develop a criteria, and that criteria is to be consistently used to identify whether the asset is an investment property or it's a property, plant, and equipment. In the instant case, the subsidiary company management has decided that they are going to use it for their own purpose, and they never intended to sell or rent out the tower, and hence in management's view it should not be classified as investment property, but to continue to be classified as a property, plant, and equipment. So what were the considerations by the committee? So the committee noted that the classification depends on the purpose or the intent with which the property is held by the owner. If the intent is not to earn rental or to sell, it could not be classified as investment property. Again, when we say that the intent is not to sell, doesn't mean that the entity cannot have the ability to sell the asset. If the sale is in the ordinary course of business, it's fine. However, it should not happen that on the day of acquisition itself, you know that the entity is going to sell the asset in next 2, 3, 4 years or whatever that period is. So the intention on at the time of acquisition or construction is to be seen. Further, the committee noted that in the particular case, it's a dual use property, meaning that certain portion is used by the owner themselves, that is the subsidiary company, and certain portion has to be leased out. If the property has got dual use, then the accounting treatment is different. INDAS 40 states that in case of a dual use property, if the properties are separable or can be identified separately and they can be sold separately, they will have to be accounted separately. The portion that is being used by the company would be a property, plant and equipment, and the portion which is intended for rental or for realizing capital gains by way of sale, that has to be classified as an investment property. And in case the property is not separable, or you cannot identify or you cannot separate the properties, it will be classified as investment property if an insignificant portion of the land is used by the owner and majority of the portion is given to the for the purpose of rental or for or held for the purpose of capital appreciation. So in the instant case, the committee noted that since this is a dual purpose building, because one portion is being used by the subsidiary company and the other is used by the parent company. However, it could not be said that it is the subsidiary is holding insignificant portion of the property or using insignificant portion, because they are using 3 out of the 4 floors. Also, the committee noted that this will be that this particular property will fall in the second category because the subsidiary cannot sell the property unless and until it is converted to a freehold property. Considering all these factors, that the subsidiary company cannot sell the asset. The intention was to use the asset and not to sell the asset or to earn rental income. Moreover, the subsidiary is using more than insignificant portion of the property. All these considerations, considering all these factors, the committee opined that intention is the first thing that we should see when identifying or classifying an asset as an investment property or a property, plant and equipment. And in case it is a tricky situation and it is not a clear-cut case, the company should develop a policy, and basis that policy or basis that policy application of that policy, whatever conclusion is reached, the treatment should be according to that. In the particular case on hand, the intention was to hold it for administrative purposes, and hence it should not be classified as an investment property. Any comments or any questions any of the participants have? Please put it on the chat as and when you have any questions, so that I can take it up at the end of the EAC. So as we discussed, few of the critical relevant sections of INDAS 40, paragraph 5 of 40 states that investment property is property which is held for rental and capital or for capital appreciation or for both, but does not include property which is used in production or supply of goods and services or for administrative purposes. or which is held for sale in the ordinary course of business. Paragraph 10 deals with the dual purpose property. It says that portion which can be sold separately, it would be treated, the portion which can be sold separately will be treated as an investment property, and the portion which is used will be treated as a PPE, unless it is inseparable and or it cannot be sold separately, and only an insignificant portion is used by the entity. Paragraph 14 talks about judgment that is to be exercised. So this was from the standalone financial statements of the subsidiary. I would just like to highlight to the group that the treatment might change in the consolidation books. Because when we are looking at the consolidation, we are looking at the we are looking from the perspective of the group and not an individual entity. So within the group, this asset is there which is used for administrative purposes, either by the parent or by the subsidiary, would not matter. But since it's a group concept, we'll see from the perspective of the group, and in the consolidated financial statements, in the same case, it would be treated as a property, plant, and equipment. So adjustment would be needed to that extent. Okay. Anyone, any questions? I don't see anything on the chat, so I'll move on to the next EAC, which is on accounting for major space covered under INDAS 116. So in this particular case, the company in question is in the mining business and have captive power plants. The company has multiple production lines wherein similar machines are used, and each machine has different useful life or different residual useful life and require common spares. The company had a practice to procure spares centrally and to allocate the spares to the location, whichever or to machines, whichever is in need. But as a safety stock, they were procuring all the spares centrally and storing it in the central warehouse. The accounting treatment that was used by the company was that they were capitalizing the spares at the time of purchase. However, the depreciation was not being charged. So they started to charge depreciation only when the spare was issued or installed in the machines, because that is when management said that, once it is fitted, only then it is available for the intended use by the management. Further, management used to add the installation and commissioning cost along with the spare part at the time of installation, and the cumulative of the basic cost of the spare and the installation and commission cost used to be capitalized and depreciated over the remaining life of the plant or the machine in which it is used, or depending on the past trend of the use of the spare. And as required by INDAS 16, any component or part which is being replaced was decapitalized. The book value of those part was decapitalized or derecognized. So what was the clarification that was sought from the committee? The clarification that was sought was whether it was appropriate to capitalize spare on the date of purchase and commence depreciation on the date of issue. So these are two different dates. First is when I'm actually purchasing this spare and I'm capitalizing it. However, I am depreciating it at a future date. I'm starting to depreciate it at a future date. Is that appropriate? The second question was whether issuance date of the major spare to the machinery for commencement of depreciation is correct. So now in this case, it's the same thing, but they're saying whether they're asking whether the date of issue as date of availability of space in the location and condition necessary for being capable of operating it appropriate. So the contention of the management, as I said earlier, the contention of the management was only when it is installed. It is it is in the location and condition which is intended by the management for its intended use. So is that date of starting of depreciation correct? The third one was whether the depreciation is to be charged on the purchase cost of machinery, or the depreciation is to be charged on the installation and commissioning cost as well, which will be incurred at a future date and has not been incurred. And the last question was, what would be the useful life, how the useful life is to be evaluated without, if it is to be capitalized on the date of purchase, how is the useful life to be determined when the company does not know which machine it's going to be used and what will be the remaining useful life of that particular machine. So what was the auditor's view on this? The auditor's view was the depreciation will start when it is available to use. This is the case in all the assets. The INDAS 16 specifies that whenever the asset is available for use and not put to use, even if it is not put to use, but if it is available for use, the depreciation has to start. The auditor had the same contention. However, his further contention was in case of a spare part, it is readily available for use, though it has not been installed in the machine or the equipment. It is available for use, and hence the commencement date for depreciation should be the date of purchase and not the date when and not the date when you have actually utilized it or issued it for installation in the machines. What are the management view on this? Management first contention was since there are a lot of common machines and common spares which are used across the machines, they do not know what is the residual life of the machine in which these spares are going to be used. Further, they said that the lifespan of the spares is 1 to 6 years, which means that depending on the spare, it needs replacement between 1 to 6 years. Some spares might be replaced in 2 years, some might be replaced in 6, some might be replaced in, some might be replaced after a year, and so on. And hence the useful life is estimated when it is actually fitted in the equipment and not before that. Management said that they just they keep it in a central warehouse to ensure that the operations are not interrupted, and it will be issued to consumption at a later date when whenever there is a need for replacement in any of the machineries. So this was on the date of capitalization. On depreciation, management said that they don't know when it will be issued and in which machinery it is going to be used. So they do not, they cannot estimate the useful life of the spare or the timing of availability of the spare. And also they mentioned that the company estimates the useful life considering the date of issue and the remaining life of the machinery in which the spares is being installed. Further, they mentioned that they contended that since installation and commissioning costs are important part of the cost of the spare, hence depreciating only the costs would lead to under recognition of depreciation and under valuation of the asset in question. Lastly, their contention was if the spare is if the spare is kept idle, it would lead to double depreciation, one for the spare which is already installed in the machine, which on which depreciation is ongoing, And second one is the spare which is kept idle in the warehouse. So if both are being depreciated, it would tantamount to double depreciation. So what was the consideration by the EAC? EAC mentioned, the committee noted that the intention of this, the intended use of the spare is to act as a standby. So it is not necessary that the spare has to be used immediately. Even if it is kept as a standby, it is the intended use of the spare, and therefore it is ready when it is. Therefore, it is ready on the date of acquisition and not on the date when it is actually installed or put in the machine. Secondly, capitalizing cost of installation and commissioning that will be incurred later on. Committee had different views basis materiality. Their contention was, if the cost is immaterial, then straight away the company should charge it off to the statement of profit and loss. In case it is material, it is to be added to the cost of the it is to be added to the PPE cost along with the cost of the spare. So considering these factors, what were the conclusion of the committee? The conclusion of the committee was the company should capitalize major spares when they meet the definition of PP&E. That is, it is probable that the future economic benefit associated with the item is going to flow to the entity, and the cost of the item can be measured reliably. In this particular case, yes, both the criteria are met. By replacing the part in a timely manner or as needed, the company can avoid breakdowns, operational issues, which will result in higher productivity, and hence economic benefit is going to flow to the company on account of these spares. And secondly, the cost can be measured reliably. You generally know what is the purchase cost going to be. So hence it is eligible for capitalization, and it should be capitalized. Secondly, the committee opined that the date of issue to be considered the start date for the purpose of depreciation is not correct, and the depreciation should start from the date of purchase. And depreciation will only be on the cost of the spare, because the installation and commissioning cost has not been spent till that time. And as we discussed earlier, if the installation and commissioning cost is material, then it will be added to the cost of the PP and depreciated along with the life of the PPE. In terms of the useful life of the spare, the committee opined that it has to be done basis technical study, and it should cover both the periods. It should cover the period for which the spare is lying idle in the warehouse, plus the period for which the spare will actually be used in the machinery. And other factors that are to be used for determination of the useful life is the intended use of the spare, and also historical data. In most of the cases, when our clients or companies have factories, the operational people know which spare is to be used or replaced after what period of time. So committee was of the view that that fact pattern also has to be taken into consideration at the time of determination of the useful life. Just to give an example, if the company has purchased the spare and it intends to be kept idle for about a year, and then it is to be issued. This is basis the historical fact pattern. And once it is installed in the machinery, it is to be utilized for 3 years, after which it would need a replacement. So in this particular case, the useful life of that particular spare would be 4 years, and the depreciation would start, the depreciation of of the relevant cost would be over a period of 4 years, and it will start from the date the spare was actually bought by the company. So this was the end of the second EAC. If anyone has any questions, please let me know. Okay, I don't see any questions, so I'll move to the next EAC, which is again on INDAS 60, but we covered major spare, but now it will be now what we'll be covering is what happens to subsequent expenditure that is incurred on PP&E. So in this particular case, again, it is a government company. It is in the business of mining. And it operates washery plants. Washery plants are plants where the coal is washed and to increase or purify to reduce the ash content and to increase the calorific value of the coal. The amount of energy that can be generated of the coal, it is washed to remove the ash, and that's how it increases the calorific value or the amount of heat that can generate. The plant was, this particular plant in question was commissioned in 1986 with an expected useful life of 15 years. So by the time the EAC, the question was raised to the committee, it was already 20 years before which the useful life had ended. Over the years, since it has completed its useful life, the utilization was poor and was very poor. The capacity utilization was very poor. It was gradually reducing year-on-year basis, and the number of breakdown hours increased. So the company, in order to tackle the situation, the company appointed a consultant to review what is to be done to improve the capacity utilization or to reduce the breakdown hours in order to improve the operations at this particular plant. The expert advised that certain work needs to be undertaken for structural strengthening, replacement of certain parts which needs replacement, and construction of new pieces or new civil work, etc. Basis the recommendation of the consultant of the expert, the company floated tender, and tender was avoided. The tender was awarded to include design and engineering work, supply and fabrication work, along with strengthening of the existing civil and structural work, erection, commissioning, trial runs, performance guarantee, and also for operational maintenance of the replaced parts for a period of 4 years under the defect liability period. For the particular year, the total tender value was for about 43 crores, and the company had spent about 28 crores in that particular financial year. As a matter of policy, the company charged the entire 28 crores to the statement of profit and loss account. So the question that was asked to the committee was whether it is appropriate to charge off the expenses incurred when it is for restoration and when it is for replacement and restoration activity with an intent to improve the operational efficiency and reducing breakdown hours. And if it is not, as in, if the expense is not to be charged to statement of profit and loss, what would be the useful life over which it has to be depreciated? Because if you're not going to charge it off to PL, then the only second option is to capitalize it as a part of the PPE, for which you'll need the expected useful life over which the asset is to be depreciated. So that was the question that was asked to the committee. However, the auditor's view was, the company auditor's view was it is to be capitalized, and it was to be capitalized because it enhanced the capacity and life of the washery, and it is to be capitalized as CWIP. We don't know why the auditor mentioned CWIP, but it was given the fact pattern that the auditor's recommendation was to capitalize it under CWIP. The management contention was that all the activities were taken to restore the degraded capacity and to reduce the duration of breakdown hours. The activities related to one particular section of the plant and machinery and not to the entire plant, and hence the benefit associated with the entire plant was not known or could not be established, because of which whether there is an enhancement in the life of the entire plant could not be established. The said activity, the improvement activities was not in nature of replacement, which is required at frequent intervals, like we saw in the earlier opinion, where in case of major spares, it is at frequent intervals, you need to replace those spares. The management of the company said that these expenses were not in replacement nature that would be needed every at frequent intervals. That was not the case. The accounting policy that the company followed, and that was one of the contention of the management, was that anything below 10 crore rupees was not componentized, because it would not have a significant impact on the financial statements of the company. And component having value, individual component having value of more than 20% as compared to the entire machine was only considered significant, and hence component accounting was restricted to those items only. However, in this particular case, all the activities that were taken were not significant because it did not cross the threshold that was set by the management for component accounting, and hence they did not do it. Further, they said that none of the items have separate useful life. If you're doing a structural work or structural strengthening work, so you don't know what will the individual useful life of that asset, or you're adding or improving on certain machinery bit, so you don't know what is going to be the useful life of the bit that you have worked on. You can estimate for the plant as a whole, but you cannot estimate for the individual component. Lastly, or the another contention of the management was that individual items are not material, and it is insignificant compared to the overall cost of the machinery, and hence it is right to expense out those charges rather than being capitalized. Lastly, what they mentioned is the plant had already completed its useful life some 20 years back. It was capitalized in 1986 with a 15-year life. So, they completed the life in 2001. And the financial year in question was 21-22. I guess it was 21-22. So, it had already completed its life 20 years back, and it could not be estimated whether the rework that was done, or the structural work, strengthening work, renovation work that was done, or restoration work that was done would increase the life or enhance the life of the washery. And considering all these factors, management found it prudent to charge it off to the profit and loss account. So what was the considerations that the committee did in the given fact pattern? So the first thing that the committee noted was the concept of materiality, whether the amount is material or not. The committee mentioned that if it is material, if it is not material, you please charge it to statement of profit and loss account. And if it is material, you have to see whether the capitalization criteria or the recognition criteria under INDAS 16 is met. And if it is met, you please capitalize it. Now, so the committee went back to INDAS 1, where there is a definition of materiality, which is to say that any information is material if omitting, misstating, or obscuring it could reasonably affect the if the information will be considered as material if omitting, misstating, obscuring it could reasonably be expected to influence the decision that the primary users of the general purpose financial statement make on the basis of those financial statements, which provide financial information about the specific reporting entity. It also states that materiality depends both on the nature and magnitude of the information, or both. So all it says is if the user of the financial statement would determine these expenses, or it would affect the decision of the users of the financial statement, then the information will be considered as material. And if the user would deem these costs to be immaterial considering the size of the balance sheet and the profit and loss account, then it could be or it would not affect their decision, then it could be considered as an immaterial item, in which case it is to be charged to the profit and loss account. Further, the committee noted that the recognition principle of recognition principle of INDAS 16 is equally applicable to the cost which is incurred subsequently to add or replace a plant, as it implies to a new plant. So whatever recognition principles of INDAS 16 are there, which we use for capitalizing new plant, the same principles are to be used for capitalizing old plants, or the same principles are to be used for subsequent expenditure as well. So what are the conditions? The condition is whether future economic benefit is going to flow to the company by use of those assets, and whether the cost can be reliably measured or not. So these are the two conditions for recognition of PP&E. So the committee opined that if these two conditions are met for subsequent expenses, you please go and capitalize it. So now, in the instant case, whether it has to be capitalized or not. So the committee mentioned, or the committee observed that it will lead, since it will improve the efficiency of the washery, reduce the breakdown hours, increase the capacity utilization, it will lead to future economic benefit. And hence, one condition is met. Second, the cost was known. So both the conditions are met. So the recognition principles of INDAS 16 for capitalizing it as PP&E was met, and hence the cost is to be capitalized. Now coming to the depreciation, management stated that we don't know whether it is going to increase the life or not. So hence we don't know what is the useful life and whether it has to be, and over which it can be depreciated. So in this case, considering the fact pattern, the committee noted that at the time of giving of the tender, it also included 4-year operating and maintenance work under the defect liability period, which means that at least the improvement work or the restoration work is going to be there for 4 years. So that could be one of the things that you can consider for determining the useful life of the work that is being done. Also, the committee mentioned that this cannot be the only criteria. You'll also need to do other assessment, which is to say, technical assessment, like we saw in the previous EAC as well, when we did major space, that you'll also have to see the past experience in this particular case, the defect liability period, and any such factors depending on case to case basis. The committee also mentioned that you can refer to Schedule 2 of the Companies Act. Schedule 2 gives the depreciation rate, though it does not cover any repairs. But in case needed, you can also refer to Schedule 2 for guidance in determining the useful life. So after considering all these facts, the committee noted that charging the amount to PL would not be appropriate if the amount is considered material for the entity, and since if the amount is material, and since it will lead to future economic benefits, and it can be readily measured, and the cost can be readily measured, it meets the recognition criteria of INDAS 16, and hence it has to be capitalized. And as we discussed earlier, the committee was of the view that for estimating the useful life, the technical evaluation, past experience, the defect liability period under the tender document, and similar factors are to be considered. And of course, the life has to be reviewed regularly to see if there is a change in the useful life over which the amount is to be depreciated. And lastly, general thing that you can refer to Schedule 3 for determination of the useful life as well. Okay, I'm so sorry, I did not notice a question from Sham. If purchase price is 1 lakh and when utilized for installment, the cost market is 1, which price is to be taken? So, Sham, I believe your question was for the previous EAC on space. I'm so sorry. I was looking at the wrong window. I was looking at the chat window and not the Q&A session. So, okay. To answer your question, Sham, in case of spare, if I understand your question correctly, if the purchase price is 1 lakh rupees, but at the time of utilizing the asset, the price of the product or price of the spare went up to 1.5 lakh rupees, 1.25 lakh rupees. What is the cost that is to be considered? In this case, I would like to say that since you have already incurred a lakh rupee for purchasing the spare, you are not going to increase the value that is to be capitalized. It will still be the value in your books that will be capitalized. And this question would not come in because you would capitalize the spare on day one itself when it is going to be purchased. So, there is no timing difference between when it will be capitalized or when it will be purchased and when the depreciation would start. And when it is installed for the machine, the depreciated value on the date of the installation is going to be considered. Okay. There is one more question. It's from anonymous, so I don't know who it is. It just speaks about what about depreciation in both cases. I'm not sure which cases is being referred here. My apologies. If you want to rephrase the question and which EAC it is pertaining to, I would be more than happy to take it. Okay. Any questions on EAC, the third EAC that we have covered? Subsequent expenditure on property, plant, and equipment. I'll take that as no. Okay. Moving to the next EAC, it's a very interesting EAC, especially when you have perpetual lease in the books. We see that a lot of companies get lease from government departments for a period of perpetuity or for a longer term lease. Okay, so I have a question from Mayuri. Mayuri, the management has said that the amount is immaterial. So Mayuri's question is, if management has said that it was immaterial, so why should they capitalize? Mayuri, the question that was asked from the committee was not on the materiality. The question. It was a general statement by the committee or a general observation from the committee that whenever you want to account for anything, any subsequent expense on the property, plant, and equipment, you have to first look at the concept of materiality. If it is immaterial, you please charge it off, and if charge it off to statement of PL, and if it is material amount, you please capitalize it. In the instant case, you're right. If management believes, if it is for example, if it is a 10,000 crore balance sheet, it may be material to the user of financial statement, but if it is 30-40,000 crore and the amount that they have spent is about 1-2 crores, it would be immaterial and it would not affect the users of the financial statement. In that case, management can very well take an option to charge it off to the statement of PL rather than capitalizing the subsequent costs incurred on property, plant, and equipment. In my practical experience, I have seen this happen. There are a lot of cases where the initial cost is not known to the management, so they don't know what is the amount that has to be decapitalized or derecognized. So what happens is whenever any subsequent work is done on any plant and machinery, they are automatically charged to statement of PL as repairs and maintenance work, because it cannot happen that you have the initial cost also capitalize and you capitalize the new cost as well. So that would not be correct, and hence in practice I've seen that management do not capitalize these kind of expenses unless and until it is huge and they know what is the original cost that has to be derecognized. I hope, Mayuri, I've answered your questions. Thanks. Okay. Moving to the next EAC, it's on perpetual lease in the books of the lessee. So in this particular instant, the company is involved in refining and marketing of petroleum products. I assume it is one of the OMCs that would have given this EAC. As a business practice, they take land on lease at various locations, and the leases are for perpetual period. That means that no time frame is defined, no end period to the lease is defined. The only condition is there is an upfront payment for premium, upfront one-time premium that is to be paid, along with rent which is to be paid on a periodic basis. There are restrictions on the purpose of use. The restrictions are like it can be used only for office purposes, fuel station, etc. You cannot change the layout is another restriction. Also, the lease agreement specifies that if the company fails to pay the lease rent, it would be considered as event of default, and it may lead to cancellation of the lease agreement. Not necessarily it is going to cancel, but it may lead to cancellation. So the accounting treatment that was followed by the company was they used to discount, as we do for any other lease. You discount the future lease payments, and that is your lease liability. So your ROU asset is equal to the lease present value of future lease payments. And in case of so the company did that. The only thing was, since it's a perpetual lease, there is a different way to calculate the present value. The formula for calculating present value of perpetuity is cash flow divided by the interest rate. So that's the capitalization amount that you get. So the company did that. So they capitalize the upfront cost and the present value of future perpetual lease payment as a right of use asset. On the other hand, the lease liability was recognized, and since there is no since the lease term is till perpetuity, the ROU asset was not being amortized. Correspondingly, since it is since it is perpetual, there was no lease liability also that was recorded, as in there was no interest that was recorded by the company. The question that was asked to the committee was whether the accounting treatment for ROU asset, lease liability, and finance cost appropriate, and what is the period over which it is to be amortized, and whether the unwinding entry is to be recognized, or the unwinding interest is to be recognized for lease liability. If it is to be considered, what is the period over which what is the period that is to be considered? And the last question was, if it is to be recognized and as a freehold land, what is the value that is going to be assigned to it? Here, in this particular case, the auditor's view was, since there is no defined period or termination clause in the agreement, the company had an enforceable contractual right to use the asset till perpetuity. The auditor was of the opinion that perpetual agreements is a form of ownership interest. And they also were of the opinion that under INDAS 116, a contract can be defined, or a contract is a lease, or it contains a lease only when the term is determinable. And since in the particular case there was no term defined, the auditor was of the view that in this particular case, the land parcel cannot be recognized as a right of use asset. And ultimately, their contention was this should be treated as a freehold land and not capitalized as a ROU asset. Management view was this is not a freehold land, because freehold land has got certain characteristics, some of which are that you don't need to pay any rental amounts to anyone. And you have a right to dispose of the asset or use the asset in the way you as a owner would want to do it. Like, for example, there's a very general thing that we say in normal parlance, if there is an asset, I can give it to anyone for free. I can dispose it off the way I want it. I can shut it down. That demonstrates that I'm the owner of the asset. If I'm not able to do any of, if I'm not allowed to do certain things, sorry. So if you don't have the right over those, or if you cannot freely use the asset, you are not the owner of the asset. So similarly, the contention of the asset of the management was on the same grounds, that you cannot do anything with the land. You are restricted in terms of use. Even if you have to use the asset, you need to take permission of the lessor, and hence it is not akin to a freehold land. Similarly, management of the view was of the view that control is a very important aspect in determining whether the long-term lease asset is under is to be treated as an asset under under INDAS 16, or whether it is to be treated as a right of use asset under INDAS 116. And since they have restrictions in place, they cannot transfer the land, they cannot use the land the way they wish it. They need permission of the lessor. They cannot change the layout. They do not control the asset, and hence it cannot be treated as a freehold land. And hence it is right to treat the asset as a ROU asset, right of use asset. So what was the considerations given by the committee? The committee said that in a long-term lease asset or a right to use arrangement, the first and foremost thing to be examined is whether the control of the underlying asset has passed, or the lessee only has a right over the use of the asset. So there is a difference between the two. The control of the asset means I can do anything with the asset the way I want it. And the right of use is I'm only given a right to use that asset. I'm not the owner. You have leased the asset, you can use it. For example, you have leased a warehouse, you can only use the warehouse for the purpose for it was given. So you just have a right to use. You don't own. The ownership is not transferred. So committee noted that this is one important thing that needs to be seen, whether the control has passed on, or it's just a control over the use of the asset. The committee noted that if the control has transferred from the lessor to the lessee, then you have to account for it under INDAS 16 as a property, plant, and equipment. INDAS 16 does not have the definition of control. So the committee went to the conceptual framework for financial reporting issued by the issued by the ICAI. And in the conceptual framework, the meaning of control is that an entity would control an economic resource or an asset. For an entity to control an economic resource, the future economic benefits out of that asset should flow to the company and not to anyone else. So in this particular case, the lessee cannot sell the asset, transfer the asset. They cannot do anything. So the control is not there, and hence it cannot be capitalized as an asset under INDAS 16. So the committee, so that thing was out, that you cannot classify the asset as an owned asset, and hence you cannot capitalize it under INDAS 16. So the other option was to assess it as lease. So in assessing the asset for lease, the committee noted that under the lease agreements that were provided to the committee, the lessee only has a right to use that asset, and for a period of time. There is no transfer of the underlying asset that has happened to the lessee. The committee also noted that since the lease agreement is for perpetuity, the perpetual lease can also be considered as a period of time. So the important concept here is the period of time. Lease, the definition of lease is it conveys a right to use the asset for a specified period of or for a period of time. So in this particular case, it is for perpetuity, and perpetuity is also considered as a period of time. And there has to be a consideration. So in this particular case, there was a consideration that it was given for exchange of initial premium and for periodic rentals as well. So the committee was of the ultimate view that though a specific period has not been defined, in substance, it is in nature of lease, and hence it is to be accounted for under INDAS 116. So this is the so the other things that the committee gave was the accounting treatments, which is pretty much similar to other RU asset lease liability that is accounted. The only interesting thing that the committee noted was on depreciation and interest. Management was of the view that interest should not be charged because the term is not known, so unwinding cannot be done. But the committee noted that no, it's a liability, it's a lease liability, so you need to charge interest on that portion as well. In terms of depreciation, the committee noted that since the underlying asset is land and land does not have a definite life, and since the agreement is for perpetual period, the asset virtually has unlimited useful life, and the lease term is also unlimited, and hence the RU asset should not be depreciated or amortized. This is very akin to your freehold land. Land is not depreciated because it does not have a definite useful life. It has unlimited useful life. The committee drew a comparison from the same thing, that the underlying asset is a land which is under lease, and since land does not and since the lease is for a perpetual period and does not have a definite time frame, the lease would also have unlimited life, and hence it is not to be depreciated. Lastly, the committee noted that even though the ROU asset is not depreciated, it should be tested for impairment on an annual basis. So it cannot happen that you are having an asset, unlimited asset, perpetual asset in your books, and you're not doing anything on it. You at least have to test it for impairment, even though you cannot charge depreciation because of its unlimited useful life. So ultimately, the conclusion was the transaction was in nature of lease, and accordingly, you need to record for the right of use asset, right of use liability, and finance costs. No depreciation is to be charged. Any questions on the fourth EAC? I don't have any questions, so we are good. The fifth EAC is on classification of investments of debt mutual fund under INDAS 109, which is financial instruments. So this EAC actually covers two pieces. One is fixed maturity plans, and one is ultra short-term liquid kind of funds. Okay, sorry. So interest not to be calculated on lease liability. Irshad, no, the committee noted that you will have to charge interest on lease liability. Only depreciation, because of its unlimited useful life, there will be no depreciation on it. Period is 1 year, like you do for each lease asset or lease liability. The same here, whatever lease liability on day one you recognize, you just have to compute interest on that period, for that period. Moving to the facts of the case. In case of, in this particular case, the company is a software company, and it has investments in various financial instruments, which included fixed maturity plans, liquid mutual funds, equity mutual funds, tax-free bonds, preference shares, etc. Debt funds have relatively low to moderate risk. The characteristics of fixed maturity plans that the company invested in was it was close-ended fund, which means it could be redeemed only at maturity. The intent of the fund was to generate income by investing in fixed income securities of government and largely for government securities. The cash flow that you get from the mutual fund or by investing in such kind of mutual fund is essentially principal and interest, which the mutual fund or the AMC asset management company or the mutual fund gets from investing in those securities. Usually the investments are in safe instruments, safer debt instruments. Government is virtually risk-free instrument that we have. And it could be redeemed only at the time of maturity. However, since these mutual funds were listed, it could also be traded on the exchanges. And as stated earlier, the cash flow was mainly on account of principal and interest payment that was distributed by the asset management company. What are the characteristics of the liquid ultra short-term plans? We are not talking about equity and preference shares. We are restricting our conversations to only debt funds. So one was the fixed maturity plan debt fund, and the other one is liquid and ultra short or short-term plans of debt funds. It has pretty much the same characteristics, only with a differentiating factor that it is usually an open-ended fund, or rather it is an open-ended fund, which means that redemption is possible whenever the unit holder wants. They can go to the mutual fund or the AMC and call for redemption of those units that he is holding. So this is the background about the two investments that the company or the kind of investments in which the company used to invest. Now, what was the intention of the management? In case of fixed maturity plan, the nature of the product itself is such that you usually hold it till maturity to collect contractual cash flows rather than capitalize on the fair value changes of the asset through sale. So here the concept is, if you are similar to a loan, you are not in case of a loan, your expectation is to keep on receiving interest and to keep on receiving principal as well. So similarly in debt fund, your expectation is that you will hold it to maturity. If you are investing 1 lakh rupees today, over a period of time, what kind of returns a debt fund is going to give, and what will be the maturity level, maturity amount at the time of maturity, and your anticipation is to hold it till maturity to get the maturity sum from the AMC. So that is what the company's intention of investing in fixed maturity plans were as well. However, in case of other investment, which is liquid investment, ultra short-term investments, and short-term plans, the intention was not to hold it to maturity, but it was dependent. The maturity or the redemption was dependent on the liquidity needs of the company. And whatever difference used to be there, they used to get a gain or loss on sale of mutual funds. This is very common in large corporate houses where excess surplus fund is parked in liquid funds just to get benefit of those incremental income. They are liquid in nature. They don't move a lot, so there is very less chances of change in the fair value of these products. But the only condition is that it has to be exchanged at the quoted price. So what was the clarification that was sought from the committee? The company wanted to mix all the investment and evaluate it as a single portfolio for the purpose of INDAS 109, and they wanted to recognize the gain or loss from the fair value changes of these particular underlying investment in OCI, the other comprehensive income, and not take it to PL. So that was the intent of asking the question, whether we can club all the investment as one group and assess the group rather than individually assessing the accounting treatment for individual assets. So, what was the considerations or what were the factors considered by the committee? The first factor that the committee noted was for classifying a financial asset under INDAS 109. There are two essential tests. One is the business model test. That is, what is the intention of the entity? Either it is to hold it or to hold it to collect contractual cash flows, or it is to hold it for contractual cash flow or to sell. So the business objective is to be seen. That's the first test. And second test is contractual cash flows, whether you have predefined contracted cash flows or not. In this particular case, the main factor that was to be considered was the business model test, which is to see what was the objective with which the company was holding these securities or investments. If it is holding to obtain contractual cash flows, or whether it is holding for contractual cash flows or it is holding for both contractual cash flows and selling the asset. It is very simple. If you're holding it for the purpose of only getting the contractual cash, like in case of loan, you're holding it just to earn interest, and at the end of the loan tenure, you are holding it to earn to get the principal as well. The instrument would be measured at amortized cost. In case the business objective is to hold it for collecting contractual cash and to sell the asset as and when needed, it will be classified as FEOCI, which is fair value through other comprehensive income. So whatever gain loss adjustment is there on account of fair valuation, that is not charged to PL, but it goes as a part of the other comprehensive income. To assess what the company should do in their case, the committee was of the view that the company has to look beyond their investment, and they also have to look to the investments in which the close-ended funds were investing. And when we saw, and when the company when the committee saw that they are using it for debt funds, so that is largely in case of fixed maturity plans, it was to obtain or it was to realize the contractual cash of interest and principal. However, this was not the case for the short-term fund, though the intention was to obtain contractual cash of the underlying instruments in which the debt mutual fund were investing. The other option that the company had was to sell. So at the time of investment itself, they knew that they are going to collect the cash and they can liquidate the asset as well, as and when needed for the liquidity purposes. So two different things. If you are holding it till maturity, it will be at amortized cost. If you are holding it, earning a contractual cash in between, and you have an intention to liquidate as well before maturity, it would be classified as FEOCI. That is, it will be accounted as fair value through other comprehensive income. So in the given case, the committee was of the opinion that in case of liquid, ultra short-term and short-term plans, all these would fit in the portfolio, in one portfolio, and cumulatively it could be assessed because they have a similar nature, and the intention of the company at the time of investment was similar in nature. You will earn contractual cash, plus you can sell it as well. So you can do a portfolio approach and assess the accounting treatment for those assets. However, in case of FMPs, fixed maturity plan investments, the investment objective was different. The investment objective was to hold the asset till maturity and not to dispose of or sell the asset in between, and in the interim to collect all the contractual cash. And hence, you could not merge the FMPs or fixed maturity plan investments along with other investments and assess it as one single portfolio. So in this particular case, the committee said that, okay, you have to assess both the investments separately. You can club a similar nature of investment because the intention, business intention is similar. The characteristics is similar. But in case of the fixed maturity plan, since the business intention was to hold it till the entire life of the asset, you would have to treat it separately. So these are the relevant extracts of 109. It says that it's pretty much what we discussed. It is to be financial asset is to be measured at amortized cost if it is held with an intention to hold the financial asset to collect contractual cash. And the contractual terms give rise to specific date cash flow that are solely payment of principal and repayment. And on the flip side, if you're holding it for gaining cash or earning cash for principal and interest and also to sell, it will be treated as OCI. Lastly, the third option is if it does not fall in any of the two categories, it is to be treated, it is to be measured, the financial asset is to be measured as FATPL, which is fair value through profit and loss account. Usually those are equity instruments. However, for equity instruments, you also have an policy choice. That is, at the time of investment, you can decide whether you need to treat the fair value in profit and loss account, or you need to take it to OCI, other comprehensive income. Just a point to note that that policy choice is only for an equity instrument and no other instrument is given as per the standard. This particular EAC, it is 109 is a bit tricky, but the reason why I picked up this EAC is because majority of the companies would want to play around in case of losses. They would want to keep everything to OCI so that their profit before tax, profit after tax is not affected. And in case of gain, they would want to shift everything to the statement of profit and loss account. So it is very important to be vigilant as to what is the business purpose of that investments before you can classify whether the fair valuation gain loss is to be charged to other comprehensive income, or whether it is to be done to profit and loss account, or purely whether the asset is to be measured at an amortized cost. Amortized cost is nothing but your initial cost plus accrued cost as well. Okay. So we have 4 more EACs, half an hour to go. Any questions on this EAC 5? There's no question. We'll move ahead to the next one. The next one again is on INDAS 109. This is more of a classification piece as to if the company has done a bill discounting, how the trade receivables and the amount received from the banks or any other institute is to be disclosed in the financial statements. Very common these days. In order to maintain liquidity or meet the liquidity requirements, companies very often do bill discounting, and that is one reason why I have selected this particular case study, because the accounting treatment is not very straightforward. It depends on a lot of things, which we'll be discussing in this particular case study. So the background about this case is that a listed company is in the business of electricity generation, through hydroelectricity. They sell majority of their electricity generated to state discoms. They have a contracted period over which the bills of the company are to be settled by the discoms. Discom is distribution companies, the MSEDCL, JUVNL, GUVNL, which is there in each state. You use those companies to supply electricity to your company. So there is one company which is generating electricity, other company which is distributing electricity to each households. The case is for the generating company, and the generating company sells the electricity to the distribution company. The distribution company in return gives money or clears due to the generating company. Because of in recent years, because of the stress with the discoms, they have a lot of liquidity concerns. So usually the payment period is about 30 to 60 days in the PPAs. However, discoms never used to pay on time. So what companies used to do is they used to go and discount the invoices that they raised on the discoms with the banks. And all the charges and everything was paid, all the discounting charges, the interest for the credit period that is given, and any other ancillary charges were borne by the discoms. And the benefit of the discom was, rather than paying the amount in 30 to 60 days, they get an increased credit period wherein they are able to service the dues or service the invoices over a 10 to 12 month period, rather than paying everything in 10 to 12 installments, rather than giving everything in one go. In this particular case, bill discounting has happened. The generating company raised invoices on the distribution company. Distribution company delayed in payment to meet the liquidity requirement of the generation company. They went ahead and did a bill discounting with the banks. The bill discounting was with recourse. That means if the distribution company does not pay to the bank on the due dates, the bank had the ability or the right to come to the generating company to call for their dues. And all the charges, bill discounting charges or penal interest for overdue, etc., was refunded by the distribution company to the generating company. So what was the accounting treatment that was done by the generating company? So the generating company assessed the requirements of 109 and said that the bill discounting arrangement does not result in transfer of risk and reward on the trade receivables, and hence they cannot de-recognize the trade receivables in their books. So what they used to do is, whenever the money was received, they used to treat it as a short-term borrowings from the bank. And on the other hand, they had trade receivables that were sitting in the books. Whenever the discom paid to the banks, the generating company used to offset it against the borrowings, because once the discom pays to the bank, there is no liability. A bank cannot come to the generating company that, okay, you please give me the money, because that liability has already been settled. So the way they do it, so the treatment was, when you raise the invoice, you treat it as accounts receivable or trade receivable. When you did a bill discounting with the bank, you debit the bank, credit the borrowings, because the bank could come and ask you the money in case there is a failure on part of the discom to give the money. And once the payment was cleared, the borrowings, the short-term borrowings were debited, and corresponding AR was de-recognized. So it was a gross-up adjustment or gross-up disclosure that the company was doing, because it believed it retained the risk of risk and rewards associated with the transfer. So what is the question that was sought from the committee was that there were two questions. The two proposed accounting treatment is what they approached the committee with. One was not to de-recognize accounts receivable, because management believe that, since they have received the money, they should the color changes from accounts receivable to current assets. It is not trade receivable, but it is current assets, and they'll continue to record borrowings as a liability, whatever money they have received from the bank. The alternate treatment that was proposed by the company was to net off entire thing, that, since you have already received the money from the bank, you have discounted. So, you should net off the receivable against the receipts from the bank, and disclose the amount received from bank as a contingent liability, because the bank is going to come to the company only if the discom is not paying the amount, or discom has failed to pay the amount to the bank. So these were the two accounting treatment for which consultation was sought from the committee. So the committee noted that for the particular case, it noted that everything, the interest was recovered. The interest on bill discounting was recovered by the bank upfront. So if you did a bill discounting of 100 rupees, and if the interest component was 5 rupees, the bank only paid 95 rupees after deducting the interest. Of course, a bank will keep their interest first. So, they recoup the interest on day one, and the discom will have to pay 100 rupees back to the bank. In the given case, it was also that the bill discounting was with recourse. That means if, as I mentioned, if the discom is not paying to the bank will come to the company to collect their dues. The bank is not going to directly come to the company. The bank will first go to the discom to collect money. All the receivables, all the acceptances that are there, the bank has first right over them. And whatever charges are there, the bank debits the company's account for those charges, which is subsequently recovered by the company from the discom. The committee also noted that the bank has got exclusive charge over the receivables from discom. That means in case of default by the discom, whenever the discom is paying the money, unless and until the default has been made good by the generating company to the bank, the generating company cannot claim an amount that will be received from the discom for that specific payables, because it is liened to the bank as a collateral for the loan that the company has, or the loan that the bank has given to the generating company basis the bill discounting. So that bill is the underlying, or the invoice or receivable is the underlying document or underlying security for the bank. So this was the background, and the committee also noted that all the penal interest, overdue payments, etc., was paid by the discom. So in evaluating the situation, the committee noted that the first step to note here is whether the contractual right, or the first step to evaluate here is to see whether the contractual right over the cash flows from the asset has expired. So if the contractual right to receive the cash flow has expired, then immediately you will de-recognize the asset, because you don't have a right to receive cash against that asset. In this particular case, had this been not with recourse, a bank, you have sold your asset to the bank, and you don't retain any right to collect any amount from the discom. So in that particular case, you would say that you have given up your contractual right over the cash. However, in and you will de-recognize it in the books. However, in this case, the fact pattern was such that in case the bank defaults, the bank will collect money from the generating company. However, the generating company can go back to the DISCOM to collect their dues towards the invoices. That means the company is retaining the right. So the company has not given up the right over the asset or over the has not given up the right to receive cash from the asset, and hence it would not meet the derecognition criteria. So financial asset can be derecognized when you have given up your right over the asset, right over receiving cash, or that right has expired. So in this particular case, since the generating company held on to the right to receive cash from the DISCOM, they could not have derecognized the asset trade receivables, and hence the committee opined that you will have to show it on a gross basis. You have to show trade receivables in one hand, and you have to show payables to the distribution company on the liability side. So both the balance sheet showed the asset on one hand and the liability on the other hand. Okay. Any questions on this EAC? So I have some extracts, some definitions from 109. Since I've already covered it, and in the interest of time, I'm not going to cover this again. Moving to the next EAC, it is on Schedule 3. As I mentioned, this is one interesting opinion from the committee. This is it is not similar to bill discounting, but it has got some flavor of bill discounting piece as well. And how the amount that is received from the bank is to be disclosed. So earlier we said that, okay, the company is receiving borrowings. In case of bill discounting, the company is receiving a loan from the bank. So, you show it as a borrowing, and you show it as trade receivables on the other hand. Here, the question was, in case of a channel financing, whatever the bank is giving to the distributors, is that my liability in the first place or not? And if it is not a borrowing to me, how it is to be disclosed in the financial statements. So the fact of the case is that the company is in the business of the company is in three businesses. One is consumer products, wherein they use to sell consumer electronic products, water heaters, geysers, irons, XYZ. The second business is lighting solutions. Third one is EPC business. In the consumer product sector, the company deals or sells its product through dealers and distributors, to which it gives a credit period of 30 days. And if the dealer is not able to make the payment in 30 days, the company used to charge interest on the overdue payment. On the flip side, if the dealer makes the payment within 1 to 3 days, the dealer and distributor used to get a cash discount of 2%. Usually, dealer distributor does not have the working capital limits with the bank, and hence they never was able to utilize the 2% cash discount that the company is offering. Further, the working capital of the company was also blocked. So what the company did is they entered into a channel financing facility with the bank, which meant that the bank is going to give, basis the recommendation of the company, the bank is going to give credit limits to the dealer distributor of the company. And for that, the company is also giving the first loss default guarantee to the bank. Here, what happens is the company has entered into FLDG agreement with the bank, under which the bank will offer credit facilities to the dealer distributor, and whichever dealer distributor is availing this facility, for those dealer distributor, whatever invoices are there, the company will get, or the bank will pay to the company on their behalf, and the dealer distributor will get a benefit of 2% cash discount that the company offers, because usually the payment is given by the bank on behalf of the dealer distributor within a period of 1 to 3 days, within the window where you can get the cash discount. As I mentioned, it is optional for the dealer distributor to go in for a credit arrangement with the bank. And the bank makes full payment to the company on behalf of the dealer distributor. And of course, the bank will pay after deducting the cash discount, because cash discount is on account of the benefit of cash discount will go to the dealer and distributors. Under the FLDG first loss default guarantee, the bank will come to the company for the dues if the dealer distributor is unable to clear the dues on the due date. So the question was, how is the amount that the bank has given to the dealer distributor to be disclosed in the financial statement? Here the thing is, the bank is paying the amount to the company, but on behalf of the dealer and distributor. So whether it is a borrowing of the company or it is not a borrowing of the company. So that was the question that was asked by the committee. So for this particular case, the company was of the view that in the entire agreement, the credit arrangement is between the dealer and the bank. There is no involvement of the company apart from only a recommendation and the FLDG guarantee that the company has given to the bank. The bank, at its own discretion and considering the credit worthiness of the dealer, used to allocate credit limit. There was no play of the company here. The company's lending limits were not utilized, or the company's borrowing limits were not utilized. The credit limit was given by the bank to the dealer at its own discretion. The interest, any kind of charges were borne by the distributor. Bank had the right to recover money from the dealer distributor as a first resort. And in case they are unable to recover the money from the dealer distributor, then only the FLDG, the first loss default guarantee, will come in place, and the company will be able to or the bank will be able to approach the company. But the first option that the bank has was to go to the dealer and not to the company. Company's contention was, unless and until the dealer defaults in the payment, there is no obligation on the company to pay to the bank. And bank also cannot invoke the FLDG unless and until the dealer has defaulted. So it is more of a contingent liability in nature. However, they are obligated to report it as a liability because of INDAS 109. In the earlier case study, we saw that you can de-recognize an asset only when you have given up the right to receive the money against that asset. So under the same principles, the management was not able to de-recognize their trade receivables in the current case as well. So they have grossed up their balance sheet. They are showing trade receivables on one end, and whatever money they have got from the bank on behalf of the dealer distributor, they are showing it as a liability. Currently, they were showing it as borrowing. The question was whether it is in nature of borrowing or whether it is in nature of other current liabilities. So, and the company said that, it is not a loan repayable on demand for them, because the channel financing facility is between the bank and the company, and dealer is not a party to it. the credit limit that is given, the credit limit and the FLDG agreement are to be seen separately. It is not one agreement, it is two agreement. One is between the bank and the company, and the other is between the bank and the dealer. The last contention was the bank does not have a right to demand the money from the company unless and until it is defaulted by the dealer, which is a contingent event. So though the company wanted to disclose it as a contingent liability, like what we saw in the previous case, when you're doing the bill discounting, but because of the specific requirement of 109 on derecognition of a financial asset, they could not do it, and hence they have grossed up their balance sheet. The last contention of the management was it has to be the transaction is to be accounted in accordance with their substance and economic reality, and not merely the legal form. And hence they believe that it is not a borrowing. Because they are not taking a loan from the company. It's only because of the requirement of 109 that they are being they have to record the money received from the bank as a liability. So what are the considerations by the EAC? Or the committee. The committee said that, or committee noted that the primary liability, the primary liability to pay the amount from the bank, to pay the amount to the bank, is of the dealer distributor, and it is not the company's obligation until the dealer has defaulted. Although the company has given a FLDG and a recommendation to the bank, the credit arrangement is between the bank and the dealer, and the bank at its own discretion and based on the credit worthiness of the dealer depends the amount of loan, the interest, the tenure, and other conditions of the loan that is given to the dealer. Here, the company's drawing power or the borrowing limits are also not impacted. The primary and hence this cannot be treated as a loan, and since it is not to be treated as loan, none of the company's drawing limits are used. Nothing is done. This should not be in nature of borrowings, and hence it is to be disclosed as a financial liability under current liability, because the tenure was 90-day credit that the bank gave to the company. The committee also recommended giving adequate disclosures around the nature of the facility. And in case of a default, the committee recommended, in case the dealer defaults in repayment of dues to the bank, the company will have to reclassify this as loans repayable on demand under current borrowings. We have 6 minutes. I'll take the next one quickly. Probably I'll have to leave. Actually, what I can do is I can take the third one, because the last one, it is more interesting, and I think I can complete this in next 5-7 minutes. So again, very interesting. I'll admit that I have never thought about this unless I read through the EACs. This is on the classification of accrued interest on short-term fixed deposit and flexi deposit. So here the background of the case is it's a public sector undertaking. The company invests in flexi deposit having maturity of 3 months or less. And the company accounts for the accrued interest and discloses the accrued interest along with the amount of fixed deposit and flexi deposit. The company usually does deposit with banks who do not charge them for early withdrawal. There is no premature charges or any cancellation charges that are there. bank bank accrues and pays accrued interest to the company on fixed deposit, and it also provides a statement of accrued interest which shows clearly the principal and the accrued interest. This is in most of the cases, whenever we get confirmation from the bank, they will give the principal amount and the accrued interest as well. And on the basis of such statement, management says that okay, they know what is the quantum of interest that they're going to get and the value as well. And hence they consider it as a part of cash and cash equivalent and disclose accrued interest as a part of the cash and cash equivalent itself. Usually what I've seen is I've seen companies take accrued interest as other current assets and not classify it as a cash and cash equivalent. And that is the reason I was intrigued to take up this EAC, because this treatment is very different than what we are usually used to see in our day-to-day this. So the question was whether accrued interest is to be disclosed along with cash and cash equivalent, or it is to be disclosed separately. So the considerations of the consideration of the EAC was around the definition of cash and cash equivalent. Schedule 3 does not give definition of cash and cash equivalent. However, INDAS 7 does give definition of both cash and definition of cash equivalents. So the definition of cash is cash on hand and demand deposits with bank. However, the definition of cash equivalent are short-term, highly liquid investment that are readily convertible into known amounts of cash and which are subject to insignificant risk of changes. That means at the start what is the amount that you are going to get, and that amount is secured. It is subject to very minimal variation, if any. It cannot be like, in case of fixed deposit, it cannot happen that you are putting an FD of 1 lakh rupees and you are not, and you're only getting 90,000 of it. So it cannot happen that way. So these are assets where that it is what amount you're going to get, and there is insignificant change in the value of these assets. So there were two considerations by the committee, two specific considerations by the committee to assess whether it is cash or cash equivalent. Whether it is cash equivalent, it is not cash because it is not a deposit. We are talking about the accrued interest. So it is not cash, and cash only includes cash on hand and demand deposit. It does not include the accrued part. So the committee evaluated whether it is cash equivalent, and within cash equivalent, they segregated two aspects. One is whether what is the amount of cash you're going to get, and second is whether there is a risk of whether it's an insignificant risk of change. If both these conditions are met, you can treat it as cash equivalence. So in case of the first condition, convertible to known amounts of cash, yes, the committee concluded that since it's fixed deposit, the rate of interest, what you're going to get, the principal amount, so you can easily know what is the amount you're going to get at the end of the tenure, or when you are going to break the FD. You just proportionate interest over the period or the tenure over which it was kept with the bank. So it is known at the inception of the FD itself. Now, coming to the second criteria regarding subject to insignificant risk of change in value, the committee noted that in this particular case, there was no prepayment or pre-closure penalty. Even if there were any penalties, those were waived by the banks. So there is virtually no change in the value. So there is no risk of change in value. And since both the conditions are met, it can be classified as cash equivalence. And hence, the committee concluded that whatever treatment that the company was doing, that is to club accrued interest along with cash and cash equivalent and disclose it in the balance sheet, is appropriate. Okay. I think it's 7 o'clock and I'm time's up. So I wanted to take EAC 8 as well, but since we have time up, we cannot take that. Any questions anyone has till now? Okay, I think there are no questions. I think Chandan is
Hello.
also. Hi, Chandan.
I think so. I hope, Gaurav, all of them kept you enough busy with all the questions, etc.
Yeah, there are a few questions coming, few thoughtful questions that were coming in. We took it as we concluded each EAC, we were taking it on real-time basis.
That's nice. Fortunately, I was there for last 30-40 minutes. I could hear a lot. First of all, I want to say to all the participants, so EAC opinion is something which is not covered in most of the sessions or any other internal, external trainings or etc. This was something we thought of having something different, which will give a right example, practical examples for the people to learn technically and take it forward. And thanks, Gaurav, for accepting and coming on the WRC platform and accepting something where it was not simple. A lot of hard work and back-end work Gaurav was required to do on this. And uh, considering his huge experience and most of the AC opinions he might have practically applied, and so that he can give you a lot of live experiences. We all were really fortunate to have him on today WRC INDAS and audit session. And really thanks for your time, Gaurav, and we would like to have you more on such sessions on physical and virtual mode to contribute to ICIR alpha meter. And technically, the more you share with all of us, it would be really helpful.
So certainly, Chandan, it was my pleasure to present to the group EAC. Indeed, it was a challenging thing. Not so much, giving or preparing for it. The challenge was which EAC to select to give to the group, because there are a lot of EACs out there, a lot of them very technical in nature, but a lot of them very specific to industry. I tried to take up or select EACs which people will be able to use it in their routine day-to-day activities as well. So that was one difficult bit. But thank you so much for giving me this opportunity to present the session to the group.
Thanks, Gaurav. Thanks all participants, and thanks for completing on time. It was like time bank. You completed in 2 hours.
I had to skip one of the EACs because it was a lengthy one, and it would have taken 10-15 minutes more. So I did not want to overshoot.
Thank you. Thanks for your time. Bye.
Thank you. Bye-bye. Thanks, everyone. Bye.